Welcome to the Lend Academy podcast, session number 6. Thank you for joining me here on the podcast today. If you have been a serious investor on Prosper for any length of time, then you know of today's guest. He goes by the screen name of Reflective Rupee. For a couple of years, he was the largest investor on Prosper, and this is back when Prosper used to share screen names and we could actually track what different investors were doing. Reflective Rupee has put several $1 million into Prosper, and I'm very privileged today to have him come on the show. He's actually going to out himself. We're going to find out who he really is. His real name is Brett Byers, and he is going to tell us a little bit about his strategies, why he got into peer-to-peer lending, and how he is investing today. And I hope you enjoy the podcast. Okay, welcome to the podcast, Brett.
Thank you, Peter. I appreciate the chance to speak with you.
No problem. So, long-time Prosper investors know you very well as Reflective Rupee. And I just wanted to, if you could provide a little bit of background about yourself and whether or not, how you discovered peer-to-peer lending, and just so we can find out a little bit more who was behind this mysterious person called Reflective Rupee.
Great. Yes. So my full name is Brett Byers, and I invest now under Reflective Rupee and also Reflective Rupee 2, as in POO. And so I got involved. Well, let me just give you a background on me. So I am an engineer and a lawyer by training, although I spent most of my life as a professional investor. So I went to Cornell Engineering School and studied electrical engineering, worked as a design engineer, designing CPUs or central processing units for computers for a couple of years. Then I went to Yale Law School, and I practiced as a lawyer, servicing mostly the venture capital and private equity industries for a couple of years. Served as an industry executive for a public company for a year. And then, again, for most of my career, I've been a professional investor, and I worked for a firm called VCFA, that's Victor Charlie Frank Alpha, which was the first secondary firm in the private equity venture capital area, essentially giving liquidity to venture capital and private equity investors that want out early, that don't want to wait until the companies go public or are sold. So that's my background. And the way I got into Prosper is during the downturn in 2008, 2009, at the depths of the downturn, I was buying some closed-end mutual funds that held junk bonds. And these closed-end mutual funds traded at a big discount on the really stressful days during that downturn, such that you actually could get a 30% effective yield rate on the junk bonds.
I remember that. Yeah, that was amazing.
And so when it came into late 2009, that was not possible anymore. And I was in a mode more of liquidating some investments rather than making new ones. I couldn't find investments like that in the public market anymore. And a friend of mine mentioned Prosper, and he actually didn't think very highly of it, but I thought I'd look at it. And, of course, this was just after Prosper had relaunched. And as we know, they were much improved after they relaunched in terms of the returns that investors got. And lo and behold, I saw you could get a 30 or 35% interest rate on a high-risk loan. Of course, the net returns are going to be less than that because of defaults, but nonetheless, it had the same appeal to me that buying deeply discounted junk bonds did as well. So that was really how I got into it, and I sort of just got obsessed with it, and as I think many have, and just sort of enjoyed it and was a big cheerleader for the industry and the company. So I just was doing it because it was fun. And I got decent returns out of it as well, but did it because it was fun and was looking for that kind of return and really wanted to see the company succeed.
Right. So did you go and meet with the company as you were getting going, or did you just did you just trust what was on the website and the way you go?
Well, I did enough statistical analysis and looking at the processes that I was comfortable that they were doing it right this time, as opposed to before the restart. And, of course, a big aspect was that, as you know, back then, the interest rates were bid. They were bid determined in that you could bid them down if there was excess demand for a loan. And I really think that was part of the problem going into the downturn, that everyone was pretending like there was no risk in the world back when they were investing in 2007 and early 2008. And as a result, I suspect folks then bid the interest rates down too low. And the exact opposite was happening after the restart, in that loans weren't getting filled, and I actually could go to folks that listed loans, people that might have been a C-rated borrower that had a 720 credit score and otherwise looked great, would list the loan at 20 or 22%, and it wouldn't be filled. And I'd go back to those guys and say, I'd message them through the Prosper messaging system and say, relist it at 30%, and I'll guarantee it would be filled. And I did by putting in a lot in those loans and then asking other large lenders that I saw out there to also consider these loans, and some of them would follow me and some wouldn't.
Right.
So back in those early days, I actually, when I was working full-time, I'd get up at 4 a.m. quite often, and I'd spend my time looking at the loans that I thought were within striking distance, and then I had the screen names of all the people who were investing more than $100 a loan, and I'd message a whole bunch of them and say, guys, I think these guys and girls, these are some good ones to go after. And some of them followed me, and that helped me get some of these filled.
Interesting.
Of course, demand and supply was very different back then. Then there were many more borrowers than lenders, and now it's the opposite. So.
Right. Yeah, I know. And it was much more of a community focus too, where you could message borrowers, you could message other investors, and all that sort of thing is pretty much gone by the wayside now. But that's really interesting. So did you? Obviously you were committing a fair amount of capital. Did you look at Lending Club as well, or why did you decide just on Prosper?
Well, so I did look at Lending Club. I opened an account there, and I transferred money in, and actually on several occasions. But every time I looked at it, I just didn't like their user interface. And I also wanted to do the really high-risk loans, which I think Prosper had more of.
Yeah, they sure did.
So I ended up never investing a dime on Lending Club.
Right. Okay. So obviously there's been a lot of talk about you on the forums over the years, and whether you were, a hedge fund in disguise or an individual. Can you just confirm that you were investing your own money? You weren't investing. You weren't part of a hedge fund or anything like that. Is that correct?
That's absolutely correct. It was just my money.
Right. Okay. So, and one of the great things about the old days at Prosper is that you could follow investors. I used to, see what you were up to, and I could also see that you were, you'd invested $2.5 million or thereabouts over the first. You started up in 2009, and by the end of 2011 you'd had a 2.5 billion. But then it seems like in 2012 you really dropped down dramatically. You're like when Prosper cut off the screen name, piece was about a year ago in February of 2013. You were at you only had a $400,000 principal balance, so you've obviously collected a lot of the payments and weren't reinvesting them. So what happened? What happened in 2012? Why did you slow down?
So what really has happened is I've shifted my investing to the secondary market on Prosper. So I'll give you a rough idea of where I am now. I've now invested over $5 million in total. And the amount on the primary market is still about $2.5 million, because I haven't done so much of it since that point when they shut off the screen names. But the other amount is all on the secondary market. So, and I am still very active on the secondary market. So, for example, if you look at my activity in January of this year, the month that just finished, I did not invest anything on the primary market, so zero on the primary market. But on the secondary market, I invested a little bit over $180,000.
Right.
And if you compare that to, and I've looked back at my prior months of investing, that actually would be in one of my top 10 months since I've been doing this since late 2009. So I'm still very active. I'm just focused on the secondary market.
Okay, and I should point out that the Prosper never actually recorded those secondary market transactions in the. So that was sort of hidden from view from everybody. So we didn't know whether you were just pulling your money out or what you were doing. So.
Yeah, no, exactly correct. So, and not only was it hidden from view, but there was one strange quirk to the statistics. When I would look at my default statistics shown on the various third-party websites that were getting the data based on my stream name, the defaults are actually higher shown on those third-party websites than my actual defaults.
Right.
And the reason being is those defaults include all of the defaults on the secondary notes I have purchased. Mm-hmm. So basically it shows the amount I've invested in the primary market, but then it dings me on the defaults for both the secondary and the primary defaults. So they're actually they actually show rates of return lower than I actually achieved.
Right. I imagine it would. So are you able to share what your return was in approximately in like 2013?
Yeah, no, I'm happy to share my return. So my internal rate of return, and I calculate it the very simple way, which is cash in and cash out of my account,
right,
or accounts as I have now, is just over 15%, and that dates back to 2009. I will tell you that there are times when I've had higher returns, and in particular, the primary note returns I had in the 2009, early 2010 timeframe were more like 20%, and that was in part because I was doing these deals where I'd convince C-rated borrowers to jack up their interest rates at 30%.
Yep.
And that obviously is not possible anymore. So that's a rough idea of where my returns are. And going forward, I see similar sort of returns. They may drop a tiny bit, but not too much.
Interesting. So can we just talk a little bit about your strategy on the secondary market? For a start, I use the secondary market to some extent on some occasions, but I find it hard to get to the scale. You're saying you did 6 figures in January. How do you get to that scale on the secondary market?
Well, so the way I've gotten to that scale is I have, with the aid of a very skilled computer programmer, mm-hmm. automated my investing activity, and it is nearly 100% automated. I've been in the process of automating now for quite some time, and it's more and more automated every day. I think it'll be 100% automated in just a couple of weeks. So you're right. It's very difficult to invest that kind of money without putting in a lot of hours, and then it's the question whether or not you're earning an interest rate or a small hourly wage. So indeed, I have automated that process, and which has taken a substantial programming effort.
Fascinating. So is there anything you can share? I mean, obviously, you probably don't want to give away your secret sauce that, because I look in the secondary market and there's very few notes come in at a discount. And they also still have the auction system on the secondary market at Prosper. So are you going for fixed price notes only? Are you doing auction and both? Are you looking for discounted notes? What sort of notes are you looking for?
So I will really take any note that I think will give me a decent return, and I don't have any prejudice against any type of note. So clearly a discounted note is great, although I can tell you a discounted note that has late payments may not be great.
Right.
And I actually think there's some folks in the secondary market that are overpaying for notes that have recent late payments. Mm-hmm. Quite often I see them listed. They've got recent late payments. The current payment is late. And someone listed at a 5% discount as a fixed note, and I see it go in minutes.
Right.
So someone's snapping them up, and I think they're making a mistake, frankly, because I think those notes have a very high chance of default, and a 5% discount does not come anywhere near to offsetting the risk.
Right. Well, keep in mind that these are notes that actually at this moment in time are current, because you cannot list a late note for sale.
That's correct. Now, but you can list notes that are up to 15 days late.
Right. Okay.
And if they end up defaulting before it closes, then the note sale doesn't happen. So my view is the ones that have had a lot of recent late payments, and again, maybe they had a bunch of late payments, but now they're current, or maybe the most recent payment is late and pending. Those strike me as they're only worth it if they're at a pretty healthy discount. Right. In general, there are exceptions to every rule, of course. So in general, obviously, if you get a decent note at a nice discount, a discount that offsets whatever risk you have 2 pieces of information that you have on a secondary note that you didn't have, on a primary note. Yep. One is what happened to their credit score since they, and then the second one is how they've done on their payments. So, you can look at those 2 things as well as the original listing to come up with what you think the risk is and what is the appropriate price for any given note. But we all know that that the default risk is higher at the beginning of a note cycle than it is later. So,
Sure.
You can still pay full price for a note and get a decent rate of return as long as you pick the right note that has a low risk of default. And again, you have those additional tools to judge notes that you don't have for a primary note, namely the credit rating change and how well they've done on their payments.
Yeah, and there's a lot of people I know, because Lending Club has a very active secondary market, and a lot of the people who are active on the Lend Academy forum are people who only trade in the secondary market. And because of those two reasons, they say, you can see how the credit score is trending and how the payments are going, and you're not. It's just a lot less risky if you've got a 12 on-time payments to go and place a bet on that borrower than it is on a brand new one. So I totally get that. But so you're willing then to pay a premium of say a note's at 20%. You're willing to pay a 2 or 3% premium for that note if it's got a decent history.
Yeah, I might if it has a long and decent history. I might do it. Of course, there's some risk to doing that, and the risk is prepayment.
Yep.
So if you could be guaranteed they wouldn't prepay, and you think the default risk is down to a fraction of what it was, then paying 3% is a great thing because you get 2 or 3. You're getting 2% a month on the interest, and so you make up that pretty quickly. But if they may prepay, you may find yourself actually losing money if they prepay immediately, or getting a lower rate of return if they prepay in a couple payments. So I don't like to go too high on the premium, but you can go to a quite modest premium, I think, and still make it, and that can still be helpful to your return.
So how many people, do you think are really active? You've studied the secondary market very closely. How many people are active on there like you are?
Well, there are really only a handful that have been there that are consistently there and that have been there for 2 years. So it's very few that have been that. What I see is there are people that kind of episodically come in and out. And, of course, it may change going forward. I don't know, but that's what I've seen so far. And sometimes I see that there are a whole lot of people bidding, and it's way too competitive. Sometimes it's less competitive. So it varies. It's a great deal.
Right. So then, are you still adding new money today, or are you just reinvesting what you've added?
I really have been mostly reinvesting the last year or two, but it goes up and down based on what the supply of notes are.
So if you find there's a lot of notes coming on the secondary market, like someone suddenly needs to liquidate all of their notes, they've got them at par, and boom, you'll say, well, I need to snap up a lot of those.
Exactly, and basically my viewpoint right now is I will take 100% of the notes that are at a good price that I can buy. So the market should grow theoretically since Prosper's been growing, and of course I have not seen whole notes selling on the secondary market. I'm not sure I ever expect to. So they're really the individual investors that are selling. So maybe it isn't growing that fast. I'm not really sure.
Yeah, well, the retail platform is growing, but it's not growing nearly as fast as the whole loan platform for sure. So exactly. Would you be interested in, because we've talked about there's been a lot of talk about an alternative secondary market or a more robust one that includes whole loans. Is that something you would welcome onto as an expansion of Folio's offerings?
Yeah, no, I think it would be great. I think, and it's probably inevitable. I'm not sure which direction it will take. There may already be effectively a secondary market, and some of these big institutions are effectively securitizing in some form or another their investments. So it's essentially a way to do it. So, but I certainly will welcome it. From my point of view, as you know, I've run institutional funds with third-party money in the past. What I'm doing now is just kind of my personal little play box with my own money, and it's very small. It's just not big enough to be institutional, but if it could become that in the long run, and then it might be interesting to have an institutional backed fund of some sort. Sure.
So then, have you been? Well, firstly, what do you think? You've been in Prosper since 2009. That's even before I started on there, and it's definitely been an interesting time. You've got, like 2009 and 2010 were just absolutely fantastic for Prosper investors on average, because I think they really went overboard with making sure they provided great returns after their less than stellar start in 2006 through 2008. So What do you think about the evolution that Prosper has done, particularly like right now? You've got you had Worth Blanket 2 come on, which I'm sure you're fully aware of, even though they weren't going on the secondary market. How do you feel about Prosper's evolution over the last couple of years into more of an institutional centric player?
Well, I think it's inevitable, and I think it's great, and I want to see them succeed, so I certainly support it. Obviously, I come from the point of view of an individual investor, and I would tell you that many of the tricks I had as a primary investor are now gone. So, I mean, for example, one of the things that I thought was one of the greatest indicators of how likely a loan might be to pay off would be the length of the description they had. And, that someone was willing to put a lengthy description probably indicated that they were a little more serious and less likely to default in general, not always.
Mm-hmm.
So I actually saw it as a positive indicator. That is, of course, gone because there are no more descriptions. And there were various things I would look for in those descriptions. If there was a sign of stress, such as my husband just lost his job, that was one I'd stay away from. If it was one that said, I just got a divorce, I'm on a new start, that was someone I'd go to because my view, those people were really trying to make a new start and they're less likely to default. So all of those goodies are gone. And, of course, one of the things I'd love to do is invest in repeat lenders, repeat borrowers, which Prosper has effectively lowered the interest rates that those folks get deservedly. So as a result, that game is gone. So a lot of the games I played or methods I used to get good returns on the primary market are gone. So, but that's the way of the world, and it's now more of an arms race in terms of folks getting on there, buying loans quickly, analyzing them quickly. You really have to do it through the API. If you really want to be competitive, you got to do it through the API, and you have to be super fast. So that's just the way of the world. I think it's it's great. It's just different than what it was.
Right. Yeah, that makes sense. So back when you were on the primary market, you were looking at individual loans and considering them by hand. Did you not have an automated way to invest on the primary market? I
did not. So my intention was that I was going to automate it. I actually considered at one point raising institutional fund to do this, and while I do have some minority kind of advisory roles with some other folks in that arena, I decided I don't want to do it myself. So I didn't go down that path, but I did consider it, and my grand plan was to not only automate the secondary market, but to automate the primary market investing through the API, which of course many folks have done at this point, and just take the kind of algorithms I use in my head and put them into software. So I never did that. I mean, I will tell you that my primary note investing was still fairly time efficient in that from looking at these, once you look at a couple hundred of these things, your brain is like a computer, and you can decide what you're going to do in about 0.2 seconds, and it would take an amazing piece of software to actually duplicate that. Mm-hmm. And I did some statistical stuff, but it was a little more seat of the pants. But nonetheless, I believe I substantially outperformed the marketplace as a whole, so I think it worked. So I never did automate it, but I've given you some hints at some of the things I would have done. I would have looked at the length of that, and of course many other things too. You obviously got to look at numbers too. Mm-hmm. It could have been, but I never actually did that. I did it. Of course, I was investing large amounts. I mean, there were times when I'd invest $5,000, even $10,000 in a loan. Certainly, a couple thousand in a loan back in those early days in 2009, 2010. Right. So there was some efficiency to it. If I could look at a loan, make a decision in a few seconds, it still was somewhat time efficient. But then I also saw you investing sometimes like $25 and $50, and I thought, what the hell's he doing? He's got $2.5 million. I did. So what I did is I had various methods. I had the simple automated plans that Prosper allowed you to do. Prosper allowed you to use various plans where you could search on something and then automatically put in a bid. Yep. So at various times I just had my automatic search, and it would just put in a $25 bid, and then I'd look through these and decide which ones I want to put a lot on. Mm-hmm. So, it's kind of like what a card counter does at Vegas, where you put in a small bid, and if you really like it, you put in a huge bid. And that's kind of what I did. Was it optimal? Not necessarily, but that's what I did So,
Okay.
and if I felt strongly about it, then a large bid would go in, and most of the money was really in those large bids.
Okay, that makes sense. Right. So then, have you actually met with anyone from the new management team at Prosper?
I have. I've met with Ron Suber, and I've talked with him on the phone several times, and I really like him. He's a great guy.
Mm-hmm.
So big fan of Ron, and but that's it so far. I'm just kind of focused on my. If I were doing an institutional fund, obviously I'd know them a lot better.
Right.
But Ron is the guy I know.
Yeah. Okay, that makes sense. So then, because particularly if you're really focused on the secondary market, that's I can see why they're not as you're not saying I'm going to bring another $5 million on the primary market. You're as far as their numbers go, as far as their origination numbers go, what you're doing is not going to make much of a dent, even though you're a very large investor. So I can see.
Yeah, no, it doesn't. And Ron has encouraged me on several occasions to go raise a fund, and I really considered it. I even took my the FINRA test to get qualified. I even started an entity, but I just personally at this stage of my life decided against it. It's very competitive. The huge guys are getting into it. I just didn't want to do it. I enjoy and like my little secondary automated investing, and maybe someday it'll turn into something more. I do, again, have some very limited kind of advisory roles with a couple of groups, but I do not want to. I mean, this could, if I wanted to, this could consume my life. This could
I can see, for sure.
A week thing, and I could work on building a big money management firm. And I've thought a lot about it, but I decided I just don't want to go that direction. And Ron encouraged me to do that. Nonetheless, I do think I'm actually providing some value to them on the secondary market. I think that a primary market can be supported by having a good secondary market, and I can assure you that I will buy any decently priced secondary note. So there is, I basically am offering liquidity to these investors, and I think that's of value to Prosper. And I think they see some value in it, but it's not the same as me raising a big fund and investing a ton of money in their primary market.
That makes sense too, because I feel like, the secondary market on Prosper, it's not as competitive as it is on Lending Club, because they don't allow the extra states in. Like if you live in New Jersey or Texas, you can play on the secondary market in Lending Club, and you can't play on it in Prosper. So I think you are providing a valuable service there, where if you weren't investing, there would just be a lot less liquidity. Because I've seen Prosper shared some of the numbers with me about the volume of transactions on the secondary market, and you're not talking large numbers on a daily basis. And so I imagine you're probably, I don't know, between 25 and 50% of the volume that they're doing on the secondary market. You'd probably know that better than I would, but it's certainly, I'm sure you're a big chunk of the liquidity out there. Yeah,
my wild guess is I'm 50%, but I have never done numbers on it, so I don't know. That's just me based on what percent of my bids I'm winning roughly, and sometimes I win 90% of them, sometimes I win 10%, but on average it's usually more than 50%. So I assume 50% of the market, but who knows?
So, and let's just before we wrap up, I want to go back to the secondary market strategy and just revisit a couple of things. So, first question: do you not really care about the underlying credit data on the borrower as long as they've got a good payment track record? You say you'll invest in pretty much anything that's fairly priced. So if someone has 4 inquiries and 5 recent delinquencies, that's okay as long as they've made 10 on-time payments?
Yeah, no, that's exactly true. The more payments they've made, the less relevant all that stuff is. If they've made 20 payments on time, that stuff becomes quite irrelevant. 10 payments, it's fairly irrelevant. If they've only made 2 payments, then it's actually quite relevant. So because you're almost buying a brand new note in that case. So if you were really optimizing it, you'd have a mechanism for picking primary notes and secondary notes, and you'd kind of have a sliding scale between the weight of those depending on how many payments are made. That's pretty complex. I basically just put more emphasis on ones with more payments, but I buy them even if they have 1 payment. If they've gone up or if they look high credit score, I'll buy them.
Right. So then are you playing and then on the fixed price as well as the auction market? You play in both places?
I do pay on the fixed price, and there, of course, the issue is speed.
Right. So you're not going the auction?
Oh no, I do both. I do both. I do everything.
Okay, yeah. So then you've got parameters in place, because I know I've sometimes tried to bid against you on the secondary market, and it's like I put a bid in, no, it's not accepted. So you've obviously got if part of your algorithm is what your max is that's worth paying for this particular note.
Exactly, yeah. So some notes, again, are a slight premium, some are only a discount, and I don't, as you know, the way that market works, you can put in your very best bid.
Yep.
But it only gets up to that price that someone bids you up to it. So yep. I always just put in my very best bid, and it ends up where it ends up.
Yeah. So if you're not going to go over that, if someone outbids you, it's just sayonara. You don't bother.
I don't bother. Yeah. I mean, the only way that you might see me bidding twice is if I've changed my algorithms and we rerun my program, which then will look at every note again because we changed the algorithm. Or if it's a big note, I might look at it by hand if it's a really big note and decide, well, maybe I'm willing to pay a little more for that, and my software is not so perfect, and I'll bid a little more by hand on something.
Right. Okay, fair enough. So then just my last question, what are your like you mentioned you don't want to do an institutional fund. Are you just going to keep going with the way you've been going, and you're not planning on ramping up or ramping down? You just what are your plans for the future at Prosper?
Well, so my plans are very short term at the moment. Just continue my automation, perfect it, and I do not. It's possible if the volume got up enough, I'd bring in a third party investor to invest with me, alongside me through an entity or something. And this could lead anywhere. I mean, I'll tell you, basically, I basically retired from my firm after 13 years with my secondary private equity firm. But I use retired lightly, as I'm actually now more busy than I've ever been in my life.
Right.
And I basically have been focusing on my personal investing, which includes a lot of private equity venture capital investing, and includes this Prosper investing. And any of that personal investing could turn into something bigger. In fact, I've had actually a number of folks say they want to invest with me, but at the moment, I'm not raising a fund any kind for either venture or peer-to-peer. But I may decide to at some point. I actually am working on sort of a stealthy startup with someone right now that's going to be uncloaked in a couple of months, that really related to an esoteric part of the private equity venture capital market.
Okay.
So that's really where I'm kind of focused. Again, I do have some very minor advisory roles, and I do keep in contact with folks in this area. I just emailed several times with Ron Zuber yesterday, and they're folks I keep in contact with. Brendan Ross is a guy I've spent a lot of time with. I'm really impressed with what he's doing with his direct lending investments.
Yep.
And I'd invest money with him if I didn't already have a decent amount invested with Prosper. But so there are a lot of great things going on out there, and I'm keeping in touch with people, but I'm not at the moment ramping up anything big. It doesn't mean I won't in the future.
Right. Okay. Well, it's been fascinating, Brett. I really appreciate you coming on and outing yourself in this way, because I know that a lot of people have been very curious about you for several years. So I really, really appreciate it.
Great. Well, I say hello to all my old Prosper friends, because I used to message them every couple days, and that was back in the good old days. And
right.
But it was a lot of fun, and I think it still is. It's just a different scene out there now.
Right. Okay, well, great. Thanks a lot, Brett. I appreciate your time today.
Great. Thank you very much, Peter.
Okay, see ya.
Bye-bye.
Okay, well, I thought that was absolutely fascinating. I hope you did too. It's just amazing to me how someone has really taken a really overlooked part of the peer-to-peer lending landscape, the Prosper secondary market, and developed a strategy that is unique and obviously very effective. And, he is providing a great service for Prosper investors by providing a great deal of liquidity for people who want to sell their notes. So before I sign off, just one last request. We are still a pretty new podcast. This is just session number 6, and I'd love to get a few more reviews on iTunes and Stitcher, however you are listening to this podcast. If you could do me a huge favor, go and write an honest review. I'd love to hear your feedback. And thank you very much. We'll talk to you again soon.